Somehow it feels to me like the model that you are inspired by and really going for the replication of is based in a philosophy of integrity and a very deep, profound trust that when they're formed, these state-run banks, using this model, that they will act in the state's interest. How do you have such peace that that will happen the way you're envisioning it?
Well, I just don't see that we have much choice. Congress at the federal level is totally locked up. There's no hope of doing much there, I don't think. But the states are still, you can still get into your state legislature and talk to the people and have an impact. And it's all a question of how the legislation is designed. I mean, we do have a legal system, and we can, the difference between a private banking system and a public banking system is you can see everything that's going on. I have read that public banks in third world countries, they're quite often public banks in third world countries, and they are often corrupt. But that was when they could be corrupted. In other words, when things could be hidden. But now, with computerization, it would be quite possible to make every single transaction of a bank available for anyone who wanted to look. So we could keep them honest if the law was that this had to be totally transparent and available.
Are you suggesting a kind of legislation for that kind of transparency? Do you think that would be necessary in order to build it in harmony with the public banks?
Yeah, I do. The difference between the argument for the Federal Reserve being able to keep everything quiet or the banking system itself being able to not tell you what they're up to is that supposedly the whole banking system is built on trust, and if people lose trust in these different banks, they pull their money out. Well, that's because the whole system is a fraud. I mean, it's a misplaced trust. They're hiding the fact that banks are issuing the money that they don't really have. I mean, they're pretending to create credit they don't have, and then they scramble around and they try to borrow from the other banks, to cover their deposits, to clear their checks. And if for some reason there's a credit freeze, if the other banks aren't lending, as happened in the fall of 2008, and apparently is happening right now in the EU, so we could be heading for the same thing again. You have these periodic collapses which happen because of, they call it a failure of confidence or a failure of trust in the banks, but for good reason. People find out that the banks aren't to be trusted, that they don't have the money, and then everybody rushes and pulls their money out. But you could set up a public banking system where you were totally transparent. You would say, we're not advancing our money. This is not our gold that we dug out of the ground and we're lending it to you. This is credit. This is the credit of the people, and we create the credit as needed. We give credit to creditworthy borrowers. In other words, the credit is a monetization or an advance of money to people that have demonstrated their ability to pay it back. And then, so basically we're just writing an overdraft in these people's accounts, and they have agreed to pay it back. We've got a legal system in place so we know where to find them. We'll make sure that they pay it back, or at least they'll pay interest until they do pay it back. So that's the purpose of a bank, really, is to oversee a legal agreement between borrower and seller. Between the seller and the buyer, but the buyer wants to buy over time and the seller wants his money right away. So the bank is there to give the seller his money and to make sure that the buyer pays back over time. It's a public function, should be a public function, it could be a public function. And if we're totally transparent in it, there would be no reason to lack confidence in our banking system. We would know what it was all about.
I'd like to talk to you about the S&P downgrade. Let's talk a little bit about it.
August 1st was the date that, August 1st was the date that the Obama administration made huge concessions in order to get Congress to agree to raise the debt ceiling. So this was all about demonstrating that under no circumstances would we default on our debt, even if it meant giving up Social Security and all these things that are the rights of the people. And this was to prevent a downgrade. And 5 days later, S&P, Standard & Poor's, announced that they were downgrading the U.S. debt from AAA to AA+. And when that announcement was made, Treasury Secretary Geithner said, "Oh, this is a huge mistake." And they looked over the numbers and found that there was a $2 trillion error in S&P's figures. And S&P went back and came back an hour later and said, "Well, you're right, we agree, but we're downgrading anyway," as if it had been decided. The downgrade was going to happen today after closing a market on Friday, no matter what. And so on Monday then, we had the biggest stock market collapse that we've had since September 15th, 2008, which followed on the bear raid on Lehman Brothers on September 11th, 2008, interestingly enough, where the Lehman Brothers stock lost 30% on that day. So we had the largest stock market drop since then. It was 600 and some points on 8/8/11, which people who are into conspiracy theories have made something out of the numbers. But anyway, and then on Tuesday, you would have expected that it would continue on down as happened in 2008. But instead, there was this remarkable turnaround, and it went back up by the same amount. So for 8 days, from August 2nd for the next 2 weeks, there was an up or down, a roller coaster ride of 400 points up or down every single day. So it was unbelievable. It's like there are these two giant forces that are fighting. One's driving it up, and one's driving it down. One's saying, "We're going to crash this market," and the other is saying, "No, you're not, and we're going to go to whatever length." So what saved the market on Tuesday was the fact that the EU, the ECB, European Central Bank, came through and said that they would indeed buy up bonds of Italy and Spain. That these are huge debts that before they had declined to undertake, but they were going to do that after all. So they're basically doing quantitative easing, which is something that's not approved in the Maastricht Treaty. The whole idea of the EU is supposed to be a fixed amount of money, just like a gold system.
I want you to explain quantitative easing to the public. A lot of people are confused about what it is.
Quantitative easing is easing the pressure on the amount of money or the quantity of money out there. Basically, people call it government money printing, but that's not really what it is. What it is, in the U.S., when the Federal Reserve has done quantitative easing, it's really an asset swap. So the Federal Reserve decides to buy something, and they create credit on their books, as the Federal Reserve is allowed to do as the lender of last resort. So basically, they create dollars in an account. So QE1, Quantitative Easing 1, was all about buying mortgage-backed securities, toxic debt off the books of the banks, because there was a credit freeze, and they couldn't meet their capital requirements. And so there was 2.1 trillion, I think. I'm not sure my figure. No, I'm sorry, 1.2 trillion of QE1 used to buy mortgage-backed securities off the books of the banks. So now, instead of having these securities, the banks had 1.2 trillion in excess reserves, and the Federal Reserve had the securities. So from the point of view of the bank, it makes very little difference whether they have, well, it's more obvious. Let's talk about QE2. On QE2, the Federal Reserve bought government securities, medium-range government securities from the banks. So the banks now had the dollars, and the Federal Reserve had the government bonds. So nothing's really changed except the form in which the money is held. In other words, the banks don't have any more money than they had before. Before they had, in that case, it was 600 billion. So before they had 600 billion medium-term government debt, federal debt, and now they had that sum in